All right, we just came out of Labor Day, heading into the fall season, and fall season is going to start out slow. But as we look at the numbers, look at the trends, I think things are going to pick up as we head towards the end of the year and the beginning part of next year. So hang in there because it looks like we finally have signs that the interest rates are getting ready to break. This is Steve with the Malone Home Team over at EXP. All right, so I like to do this every month. I think last month we may have missed because I was at the beach chasing kids all over the beach, so we missed last month. But we look at the past data in the metro Atlanta area, see what happened coming from August into September. All right, so let's see what the numbers were compared to the month before, compared to the year before. Kind of take a snapshot of where we are right now, and then we're going to talk a little bit deeper about mortgage rates, where we are right now, because they are stubbornly staying above 7%. I think there's a breaking point coming. Okay, we study this a lot. We follow a lot of folks that are keeping their eye on the market, and there are some things that we're watching now that are showing that interest rates may actually start to fall as we head towards the end of the year, and especially in time for next spring. Now, keep in mind when we say interest rates are going to fall, we are not talking about interest rates getting back to 2%, 3% like they were. Okay, if you got a rate at 2%, 3%, congratulations, hang in there with it if that's what you want to do. If you're waiting for the rates to get to 2% before you do something, enjoy that seat you're sitting in. You're going to be there for a while. Okay, I don't know what's going to happen. But what we are looking for is looking for the potential for the rates to come out of the sevens, back down to the sixes, maybe even in the mid to upper fives at some point, maybe by late next year, potentially. That's the hope. Okay, are we going to get much lower than 5%? I don't think so. I think that we're going to end up somewhere at best low fives unless something big happens. We get some kind of major recession or something like that. But right now, I think interest rates between 5 and 6%, I think are going to be healthy. We just got to get there. Like I said, there's some data showing that we're on our way. So we're going to break it down. I apologize ahead of time. This is nerdy. I'm a nerd. I love data, love the stats. Let's take a look at the snapshot. Interest rates, those signs that show that maybe things are finally starting to change, and then I'll give you I'll put the cute little bow on it at the end. Let's talk about what's going to happen the rest of this fall. So here we go. Let's take a look at what happened coming out of August. All right, so let's take a look at what's going on across the metro Atlanta area. We're going to be super fast on this because I don't want this to bog down. These are numbers coming out of August. What I'm going to do is I'm going to switch this over to last year. Okay, now August sales price, we've gone from, here, let me move this up out of the way to about right there. Sales price, we come back up. We dipped down a little bit June into July, but came back up to around 516. Keep in mind, back in August of last year, we were going way down, down, down. August had dropped last year. Okay, so we're going to do a lot of this looking at it from August into September of this year versus last year. New listings were about the same. New listings added last month. Back in August of the previous, we had about 8,000. Now we're at about 6,800, so not quite as many homes for sale. Now this is taking into fact, they're taking into account all the houses that were added, all the houses that are taken off, all the houses that were sold. It has slowed down a little bit, so because of that, the number of homes that are for sale right now is kind of up. It's 10,623, the highest number that we've seen since about December of last year. For that reason, the month supply has gone way up, as high as it's been since around that same time period last year. 2.3 months. Keep in mind, when we compare this to let's say the last 5 years, here's where we saw the worst of those months of in supply. So month supply, we've said it before, do it one more time. This is the number where if we sold everything on the market right now, we didn't add anything else, we sold everything on the market, and we sold it at the pace that we're selling everything, how long would it take to get rid of everything? Back in March of 21 and March of 22, or the early part of 22, it was about a month. That's absurd. Okay, it's absurdly low. Typically, when you have numbers that are below 5, it's a seller's market. Below 3 is like a strong seller's market, and 1 is, as we called it, bananas crazy market. That's what it was. Then it came back up last year to about 2.4 was its highest, came back down below 2. Now it's back up to about 2.3. Keep in mind, those numbers, 2.3, still a very strong seller's market. You got to go way back. We're going to open this up to the max. You got to come way back here in Atlanta, back to February, March of 2012, this time period, where you saw anything above 5. Once it gets below 5 again, it comes in that seller's market. This was not a crazy seller's market for all these years. Then it dipped a little bit in 16, and then it really dipped when we got into the pandemic, and it's coming back a little bit. But when you look at these numbers, you can see where we are now right here, still way below where we were way back here. So we're not going to freak out about, worrying, oh my goodness, are we getting ready to, see the whole market shift or anything like that? No, just we're in a very strong seller's market. It's just not a banana seller's market. It's not like uber duper schmooper strong. It's just a strong seller's market. That's fine. It's letting a little bit of kind of steam off the machine, which is what we need. Percentage of list price down a little bit, but still holding around 99.3. Let's talk about some of these other numbers here. Let me move this out of the way. Let's see, price per square foot. That's still holding pretty steady at 215. We hit 217 back in June. That was the highest we'd ever seen because it was at 216 last year. Got to 217, holding at 215. So prices are holding strong. Price per square foot's holding strong. Shows depending down a little bit. Interesting to note that shows per listing got about 6 showings per each listing. Shows depending 14.6. So that's less than 50%. So you need a whole lot of showings to get your house sold. That's the average, okay? What do all those numbers mean? To me, that means that we're coming into fall. The numbers are down a little bit, but it's not astronomical. This is a very seasonal change. I see nothing in here that shows any issues, okay? I want to show you a couple of things that are giving me some hope as we head into the end of the year. This is a national number. The average annual inventory of homes for sale. This goes all the way back to 99, all right? And this is in the millions, okay? So we had our big push of houses that were on the market. We're back here. We had the subprime kind of disaster back 07, 08. We started adding a whole bunch of houses, and then everything collapsed. All right, so you had all these houses through 2011, 2012. Then everything started coming back into focus. Notice that during the pandemic, it came way down here to 2.3, 2.7. Right now, we're at 3.3 as far as the inventory of homes for sale. That's still way below where we were. So a lot of people are freaking out that, oh my goodness, we're having so many more houses. Look at where we compare this to since 99. So again, we're not going to freak out over this. We're still in a very strong seller's market, okay? Everything this year has been driven by mortgage rates, okay? If you want to follow mortgage rates, which I do every day, Mortgage News Daily has a great tool. They have great articles, things like that to help you learn kind of what are the interest rates done, okay? The interest rates in the last year, we're going to go back to right here. This is where they were about a year ago. They were actually, believe it or not, a year ago, they were below 5. People were still freaked out coming out of the summer because they had gone up so much. You had a little bit of a break. Once we got past Labor Day, they shot back up above 7, and they've been riding between 7 and 6 and 7 and 6 and just up and down in this range. But see, here's a 6% marker here. Here's 7.5%. It's been between 6 and 7.5%. I mean, unfortunately, you look at the rate that Mortgage News Daily quotes, it's been below 6 since, I think it was in here, something in the neighborhood of like the end of August. End of July. It was below 6 right here. July 26, 2023. It's been above 7 ever since. That's a month and a half above 7%. That's like the longest we've seen in this cycle of rates above 7%. Now, the good news is we're starting to get a little bit of releasing of the data, or releasing of the high rates. And let me show you why. This is 2 graphs laid on top of each other. Okay. And I apologize. This is nerdy stuff, but this tells a story of where we're going. Right here, you see in the blue line, this is inflation. This is a CPI. This is what they measure, the Consumer Price Index. And basically, what's in green is the 30-year fixed rate mortgage. What you see is back here, back in the 80s, when you had the big spike in inflation and everything came down, took the mortgage rates a while to follow it, okay? Then come way up here, back in 2020, 2021, when all of a sudden you start to see the inflation spiking, there was a lag from when the mortgage went up. Well, guess what's happening? The the inflation turned the corner. Inflation's coming back down. Guess what's getting ready to happen to the mortgage rates? You already see it's starting to kind of flatten here. Give it a little time, they're going to start coming down. So it's usually like what, 6 to 12 month kind of lag where you're going to start to see interest rates come down. The question is, are we truly over the top of inflation mountain? We've been thinking that. All right, now we're going to go really dorky here. This is the last thing I want to show you, and then I'll come back and talk about what I think it all means. This is off of a website, CME, the Chicago Mercantile Exchange. So CMEgroup.com, they have something called the Fed Watch tool. Okay. So the Fed Watch tool, this is their probabilities that they're going to raise the rates or keep the rates exactly where they are at their next couple meetings. Okay. So this is, I'm going to push it up a little bit. They're meeting September 20th. Their current rate is 525 to 550. That's in the basis points that they have right now. They want to be 525 to 550, or they're at 525, 550. They're meeting in September. They have a 93% chance that they're going to stay 525 to 550, 7% chance they may raise it a quarter of a point. What that means is it's going to be basically staying the same then. Then these two are the big meetings, November 1st and then December 13th. Right now, what they're showing is 525 to 550. There's a 54.5% chance that they're going to keep it where it is, 42.6% chance that it's going to go up a quarter point. What's interesting is I'm going to hit the historical button. Nope, I'm not going to do that. What would I do? It was just the compare button. That's the one. So the compare button, this gives you an idea of where these numbers were just a couple weeks ago or a month ago. All right, so this is 1 day ago, 1 week ago, a month ago. About a week ago, it was a 65% chance that they were going to keep the numbers right where they were. Now it's sitting at a 54.5% chance. About a month ago, it was sitting at 63%. It's sitting at 54.5 right now. Okay, so it's been trending that maybe there's a slightly better chance that they may raise the rates once we get into November. If they don't do it in November, let's take a look at December, because they're either going to do it in November or December if they're going to do it at all. Okay, but the important thing to note is when you look at the historical and you look at the currents, and let's just look at the current just to keep it nice and easy, there's a better chance that they're not going to do anything than move it. Okay, again, it's probably, if they're going to do anything, they're going to move it a quarter point. What does this have to do with mortgage rates? We'll talk about that in just a second. But the important thing to note is there is a 54% chance they move the number here, or they keep the number the same here. There is a, 56% chance or 54.5% chance here. And then the next meeting is 93%. So they're definitely not doing anything here. If they're going to do it, it's going to be either at the November one or the December one. They're going to make the move if they're going to do it at one or the other. Okay. Worth noting then, once we get into January, we're going to be in this 525, 550 range. In March, 525, 550 range, or it could be a little bit higher, or it could be a little bit lower. All of a sudden, you're starting to see these play in, okay? The lower numbers. Same thing once we get into May, and then in June, actually looking like that's the first time period where they're actually thinking to themselves that they're actually going to have rates lower, so they could be lowering rates by the time we get into next summer, okay? And that could end up having a big impact on the entire economy. So what does this all mean? Let's break it down. All right, to me, what does it mean? The Feds, what they're doing is they're trying to figure out with inflation kind of where we are, because they're raising their rates because they see inflation being crazy. They have to raise their rates to kind of slow everything down. The rates that they're raising is called the Fed funds rate. That's the rate that banks lend money to each other. It's not the same as mortgage rates. They run kind of parallel, or they run in conjunction. They kind of mirror each other, whatever. But what we watch what the Feds do, because what the Feds do is that's kind of, they're measuring what's going on. Like, is everything working the way it's supposed to work? When the Feds actually drop their Fed funds rate, that's going to be a major signal to everybody that things are working, that they've been trying to do. We're over inflation mountain. The Feds are they're confident that things are improving. They're bringing everything back. Everybody can get back in the pool a little bit. So what is that going to mean for mortgage rates? Mortgage rates are going, in my opinion, because we're going to flatline here for a second at this rate of either 525 to 550 or 550 to 575. They raise a quarter point, they're probably going to pull it back down a little bit faster. If they hold steady, they're going to hold it steady. We're not going to see big drops until we get into, like I said, May, June of next year. They're measuring what's going on within the economy. Okay, mortgage rates are going to be slowly dropping, in my opinion. In my opinion, if I was to put, and again, I don't have any letters behind my name, so this is all just me shooting from the hip. We're sitting around talking, so don't at me, don't yell at me. My opinion, rates are going to be in the upper sixes, around 6.75-ish, 6.8-ish by the end of the year. Probably 6.4, 6.5 by the time we get to spring, like March 1st. And then we're going to be maybe low sixes, close to 6 by the end of next year. That's my guess, okay? I don't think we get into the 5 next year. If so, it's briefly, okay? That's devoid of any kind of recession or whatever, because if we have a major recession, then all bets are off, because then things start to collapse, and they got to drop the rates like crazy to try and stimulate a little bit, because they swung too far the one way, and they got to swing the other way to rescue everybody. So the mortgage rates are going to slowly drop. But once the Feds actually start moving their numbers back down, that's going to be a sign to everybody that, okay, here we go. And I think that's going to bring the mortgage rates down even faster. Or that's going to allow for everybody to relax. Because mortgage rates are really driven more on like bond prices, market sentiment, things like that. That's why sometimes we see if the Feds are going to raise their rates, the Feds will raise their rates in the morning. They'll say, we're going to raise everything a quarter point. The mortgage rates may actually go down those days, which is kind of weird. Everybody's like, well, why'd that happen? Well, the mortgage rates, they knew they were going to raise their rates. I just showed you on the map that they're going to hold everything in September. They're slightly more likely to hold at the end of the year, but they could end up being, they may end up going up a quarter point. If they go up a quarter point, everyone's going to freak out. It's just a quarter point. It's kind of baked in there because it's kind of a 50-50 shot, I think. So nobody's going to freak out. So if they go up, you can still see mortgage rates going down. It's not going to shock anybody. If they come out and they went up 3/4 of a point, like that's on nobody's radar. They go up 3/4 of a point, holy cow, the mortgage rates are going to go nuts, right? So that's what we're watching. What does it mean for you if you're buying? What does it mean for you if you're selling? Because at the end of the day, that's all I care about. You got this far in the video. Steve, what does it mean for me? All right, so to me, what are we going to do buying wise? If you're buying a house, right now, there are buyers, there are sellers, the rates stink. I get that. All right, especially if you're selling your house and you're sitting on something that's 3 or 4%, the interest rates stink right now. Okay. That being said, home prices are going up. We don't have enough inventory on the market to hold the home prices in check. They're going to go up. They go up 5% every year, at least, in the environment that we're in right now. Okay, so if you're waiting a year to buy a house, you're going to buy the house, it's going to be more expensive. Okay, if you're waiting for the rates to come down, here's the thing I tell you is we were waiting for the rates to come down last year. They're higher right now than they were last year. If you bought last year, you have a lower rate than you would if you bought it right now. I think we're going to go lower on the rates, but they're not moving. I mean, I keep looking at my watch, I keep looking at the numbers, they keep kind of trickling up. You tell me when the rate's going to come down. I follow several guys on YouTube who are much smarter at this stuff than I am. They break down kind of what's going to happen with the rates, things like that, and they just throw their hands up like, I don't know why the mortgage rates are going up, because the overall trajectory of things is that things should be coming down slowly, but they should be coming down. Okay, but there's still this upward pressure on mortgage rates, or at least holding things steady, which is way above where they should be. At some point, they're going to drop, okay? Now, that being said, there are no guarantees. It could take longer. Some people are waiting until the rates get in the low 5s before doing anything. They may not be in low 5s for a while. It might be 2 years. It might be 2.5 years before rates are in the low 5s. They may not get in the low 5s for a while. We may hold in the upper fives to low sixes for a while. I think if it's the upper fives, low sixes, I think that that's healthy. That brings enough buyers in. I think there's enough people that say, all right, let's make something happen. And then there's no downward pressure that necessarily needs everything to be in the low fives. That's my guess right now. I mean, if you're waiting for that, it could be a while. So if you're looking to buy, grab it now. There's no competition. You jump in, grab your house, get it at a good price, and then refi if the rates go down. If the rates don't go down, guess what? You got the house at the rate that everybody's at anyway. Grab the house. Okay? This is the cheapest you'll get that house in the next 3 to 5 years. Okay? If you're looking to sell your house, this is a great time to sell. It's fall. Right now, there's nobody on the market. Okay, you saw that the month supply is going up. Part of the reason why the month supply is going up is because it's taking longer for houses to sell because there's fewer buyers out there and all that stuff, whatever. But still, when you look at the map of who's out there, you saw new listings is pretty flat and it's much lower than it's been. Part of that is, I mean, there's just no competition. So if you're looking to sell your house in a neighborhood, there might be one other house in the neighborhood on the market, maybe. You're in a good spot. Jump out now, sell your house. But if you wait till spring, you're going to have a lot of buyers come back. Maybe that's your time. Either one's going to be great. So between now and next summer, the only month I would tell you don't list your house is December. Tell people that all the time. Kind of makes people scratch their heads. Like, if you want to sell in December, I mean, if you want to sell in December, I'll list your house. You want to sell in December and get a good deal on it, I would list it before December. I would list it after December. But December, as you know, it's that month where it's Christmas, people are out Christmas shopping, people are going to parties, people are doing all kinds of stuff, okay? So don't list your house in December. Any other month can be a great month to sell your house, okay? If you're looking to buy, jump now. If you wait till spring, yes, the rates will be down, and everybody and their mother's coming back, okay? Just keep that in mind. Now, I say all that also to say, if you're looking to buy, but right now doesn't make sense from a financial standpoint, all that stuff, I'm not mad at you. Okay, you got to do what's right for you and what's right for your family, what's right for your legacy. Okay, I'm not stepping on that. I'm just shooting the poop right here. You ask me, hey Steve, what do you think? This is what I think. Jump now. If I had a bag of cash and I had to decide, do I buy now or do I wait till spring? I buy now all day. Okay, and then if I have a big giant rate that I have to get and it stinks. I buy now. Because if I have to buy and I'm going to wait till spring to buy, I'm fighting with a whole bunch of people for a house that's even more money. With fighting with more people, it's going to be even more money. And then, if the rate's lower, great. Or you buy now, and then refi when the rates go lower, it's going to save you all kinds of money. Okay? To me, that if I had the bag of money, that's what I would do. There you go. If you're looking to sell it whenever you want to sell it. Just not in December. I wouldn't do that. We'll do Christmas parties in December, then we'll sell it after New Year's. That's what's going on in the market right now. So, what do you think? What do you want to do? What questions do you have for me? You shoot me an email. Email's below. Call me 470-233-4409. And that's it. There's your update. Follow me on social. Like, subscribe, all the good stuff. This is Steve. We'll talk to you. Bye.